Okay, so I'm taking a look again here at European versus American options or American futures options. So options, there are many option future type contracts to trade. In fact, some of the more liquid contracts, in particular, options that trade on Treasury futures and Eurodollar futures. These are American in nature and have the provisions for early exercise. So European options are generally European futures. Generally, we can show are worth less than American future options. And I set out here this specific setup graph is based on ideas set out in the Robert Whaley paper from 1986 from the Journal of Finance. So Journal of Finance 1986, and Robert Whaley. Now in that particular paper he uses to estimate the option, he uses Baron-Adesi-Whaley type construction. Here in what follows in terms of our estimation, and to generate this graph in Excel, I'm using initially Lysen-Reimer just because it seems to be faster, and then we'll take a look at Cox-Ross-Rubinstein in the estimation. But again, the basic idea here is the American option, its lower boundary tends to be higher than the European lower boundary, and what will discriminate or determine the extent to which the American, think of this as the American option, so the capital C here pointing here at this parabola is higher than the European, the lowercase c, the European option, the European parabola generated by Baron-Adesi-Whaley, right, is inferior. And we also note that this European parabola for the option futures contract, it's just tandem, or its lower bound is given by f minus x e negative rt, whereas when we take a look at the American futures option parabola, right, generated for different levels of f, one level of x, different levels of futures price, it is just tangent here to f minus x, and there's no negative region. So this is actually maximum f minus x or 0. Likewise here, maximum f minus x e negative rt or 0. So largely it's observable that as we increase r and t here, as r and t increase, the gap between these two opens up, and that's largely what's determining the difference between, when we look at these the relative values of American and European option futures contracts. A large part of the differentiation between the values of those two types of option will relate to the level of the interest rate and time period. Now, other variables, parameter inputs that will impact, of course, are volatility and the moneyness of the contract. If it's a call, obviously the more we get into the money, the further f is from x. As f increases, as the futures price increases, the bigger the gap also becomes between the two. Okay, so let's go back in then to our graph. I've recreated this graph, but in this instance the approach that I took here was I used a Lysen-Reimer contract, Lysen-Reimer code, Lysen-Reimer, which is just truncated code for Lysen-Reimer, and I followed pretty much in line with Espen-Haug's code, but I added some additional modifications in that take account of truncating for the 0 region, which naturally occur in the Lysen-Reimer tree. Okay, so a good deal of the Lysen-Reimer tree will contain 0 values on the nodes, and being able to truncate Leisenreimer will speed up the estimation process. Also, we noted in the previous video that a 10-step Leisenreimer tree actually yields quite a degree of accuracy, and we can show that for the European option at least here, right? When we take the Leisenreimer value at 10 steps here, right, the value that we get is very close to the Black-Scholes value. So we had a Black-Scholes call VBA function, and the true value can be given by attributed to the Black-Scholes function, and it's 2045. So for European specification, European option using these parameter inputs using Black-Scholes would be 2045. And Leisenreimer at 10 steps is getting us pretty close to that. And then the black model, we also invoke the black model to show that the result here in the black model is the same as Black-Scholes. One additional feature that should be noted, it's generally accepted that if we take a conventional Black-Scholes formula and we set the R value equal to Q, right? So if the risk-free rate and dividend are set equal to each other, the Black-Scholes function will yield a result equivalent to the black model, and Black 1976 was originally set out to estimate the value of European option futures. Okay, so Black-Scholes, two things we can note here. If R is set equal to Q, then we can use the Black-Scholes formula to estimate a European option futures. We can do that anyway with Black 76. We note that if we subtract the difference between those two here in this instance using the same parameter values, the difference would be 0, right? Okay, so we get a value of 0. And if we subtract the difference between the black model and Leisenreimer here, okay, so if I take if I take the difference between the black model, so equal to, take this Leisenreimer estimate, subtract away Black 76, which is true, Leisenreimer at 10 steps is out by a relatively small amount. Okay, so Leisenreimer at using 10 step in their binomial tree construction yields us a level of accuracy that we probably would be content with for graphing and so on. Okay, so we run that estimate, and I ran a data table for different step sizes, and you can see for European and American specifications, if we take the yellow here, which is the American parabola, American time value for the option. In other words, if we take the futures here and then we generate a data table for different levels of F, so 10, 20, 30, 40, then the set of values that we obtain here in terms of the American option, right, can be described by the yellow parabola. So that's the American option. The European option is the gray. Okay, so the European parabola, right, is given by the gray curve here. And we can do a little bit of stress testing here to see under what circumstances are European and American options alike or close to each other, and under what circumstances do we get a significant gap. So there's two obvious ones. Given that the lower bound for the European option is this F minus X E negative RT, right? So the lower bound for the orange here, lower bound for the European option is given by the orange color, and the lower bound for the American option is given by the blue. If we can somehow reduce the distance between the blue and the orange, then we will see increasingly a convergence between the European and American option. So for instance, if the interest rate was set equal to 0, the interest rate was set equal to 0, and by default we set Q equal to 0, then the difference between the American and the European option, right, cannot be observed, at least here visually. So the European option and the American option are equal to each other when the interest rate is set equal to 0. Okay, so let's go back, if it's back to 10%. If the time period was reduced, if we go, this is a 5-year option, that's quite unusual. 5-year options tend to make up a more illiquid part of the market. More typically, options have a lifespan of 1 year or less. Now here we put it down to 1 year. We could lower the interest rate to 0.01, and you'll notice that again in a low interest environment at short maturities, that the value between the two options won't be exactly equal, but the difference becomes smaller and smaller. Okay, so in circumstances where we reduce the interest rate, reduce the time period, the relative difference between the American and European options would seem to decrease. Okay, now we'll change back to our original 5 years and 5%, and we get back the graph that's presented to us in the Robert E. Whaley's paper from the Journal of Futures, the Journal of Finance, 1986. Okay, so this type of construction, when we look at it, appears is probably for longer data type instruments, and where the interest rates were quite high. Now again, in the mid 1980s, interest rates would have been much higher than they would be compared to today. The risk-free rate would have been quite an amount higher than interest rates are today. If we go back into our Excel spreadsheet for a moment, okay, another thing we would like to point out is we could have done the same with Cox-Ross-Rubenstein. Okay, so if I substitute in here for Lysen-Reimer instead of Lysen-Reimer, I could have put in a Cox-Ross-Rubenstein set of code, which I've done here, and that follows on the back of. So let's take a look at that Cox-Ross-Rubenstein code. That's code that I had developed from Fabrice Roy from the Volupta page, and I just changed originally we had a spot price here, otherwise the variable inputs were the same. Instead of having E and RT minus D over U minus D, I've changed the ERT here to 1, and then instead of having a spot here, I refer to this as a F, linking back here to the parameter input F, and then if you like, the stock price tree or the spot price tree, the tree for the stock price is really a tree for the futures price in this instance. Okay, so we're thinking of the futures, and we're thinking of a futures price tree developed in this double loop. Otherwise, the code follows in the same vein as the original code set out by Fabrice. Okay, so if you go back into the spreadsheet and I run the estimation for a 10-step tree, so the numbers are the same as before. Okay, for this, before we had 10-step Lysen-Reimer, here we have 10-step Cox-Ross-Rubenstein. With 10-step Lysen-Reimer, for the European option, we can see 10-step Lysen-Reimer yields as a result closer to Black-Scholes. With Cox-Ross-Rubenstein, convergence is lower. So the 10-step Cox-Ross-Rubenstein tree, right, is not yielding us a value terribly close to Black-Scholes. In fact, we'd have to increase this probably to 50, 100. This instance here, I increased it to 400, and I got a value that was relatively close. But we can still, using the same parameters, generate the same type of results here, same type of graph here, using the data table from Cox-Ross-Rubinstein.